Starbucks is a company I'm sure we are all familiar with. The fast food slash coffee house business is one of the biggest restaurant chains in the entire world with shops all over the globe. The stock has also historically been a winner, with the company generally outperforming the S&P and also having an above average dividend which currently sits at around 2.5%. That being said, the company is facing some issues currently, and it has resulted in the stock being down over 25% from all-time highs and even 10% down from recent highs. So that being said, is this dividend growth stock a buy right now due to the price drop, or are there better alternatives to buy out there? That is exactly what I will be talking about in this video, so let us get right into it. Before we start this video, make sure to like and subscribe if you're new to the channel, because I will be posting dividend stock videos just like this one every few days. Firstly, let us talk about the reasoning behind Starbucks' drop in the past few months. The truth is, though, the drop in stock price hasn't been down to anything as simple as an earnings report. The price of the stock is currently sitting at around $93, which is similar to where it was in early November. However, in between that time and now, the company has posted Q4 reports where they showcase record profits. That means, contrary to what you may believe, it isn't the company's profits or revenue that is driving the stock price lower, as that seems to be doing well. The thing driving the stock loss, in my opinion, is largely based on negative news surrounding the company. This negative news comes in forms of unionization from workers and reports that recovery in China is worse than expected. Let us first talk about the union side of things. Starbucks has had a long history with battling unions, and the situation is currently no different. The contract disputes and lawsuits between Starbucks Workers United, the main union at play, and Starbucks itself have been going on for years. The union has frequently made it clear that they support a national agreement, while Starbucks would prefer to figure things out on a store-by-store basis. Starbucks has also been shown to increase wages at non-union locations, but has withheld raises from unionized stores. This has caused the disputes to continue and even worsen in recent months as the union continues to grow larger. This has obvious implications for the stock price, as a national deal for all Starbucks workers would drastically increase operating costs for the company. This is the largest concern behind the union efforts. However, Starbucks has done everything in the book to try and avoid reaching a contract with the unionized locations. The unionization isn't a small issue, but it also isn't a massive one for the company, as Starbucks can continue to postpone the problem. However, it is a lingering issue that continues to be a negative reminder for shareholders and the company itself. The second large issue at hand here is something that is definitely more tangible and definitely will affect their bottom line a bit more, and it's that the recovery plan in China is taking longer than what was expected. It is no surprise that as an international chain, Starbucks is looking to expand into China, a country with over 1 billion residents. This, for the majority of Starbucks history, has gone well. However, due to the COVID lockdown in China, Starbucks suffered tremendously. Now that the lockdown restrictions have been eased in the country, Starbucks has initiated a plan to recover lost revenue and profits. The problem is, earlier in December of last year, the CEO of Starbucks came out and said that the recovery plan in China was taking longer than expected to see worthy results. This obviously sparked fears within investors, as it could showcase that Starbucks could be pulling in less money internationally than what was seen in the past few years, ultimately hurting the bottom line. Really quickly, it is also worth bringing up boycotts of Starbucks due to controversies surrounding the Israel-Palestine war. However, it is unclear whether that is actually affecting the bottom line as of now, but it is still worth mentioning at least once. Long story short, there are a few different pieces of bad news surrounding Starbucks stock. It is still unsure how much this will affect Starbucks going into Q1 reports of the new year. However, investors have responded by selling off shares, which has caused the drop in stock price. Now, let me present some reasons as to why Starbucks stock could rise in 2024 despite some of the previously mentioned issues. Firstly, Starbucks has an extremely loyal consumer base. There is no question about it, but despite being a non-necessary item, millions of people around the world still buy coffee at Starbucks day in, day out. This has been done through a combination of two things. Naturally, coffee and the caffeine within it is an addicting substance, making it almost a requirement for many workers all around the world. Even if the drink does cost a heavy premium, many people deem it to be either necessary or worth it throughout their day. Secondly, Starbucks has made a great deal of innovation in order to keep repeat customers coming into their business. The biggest thing would be the Starbucks app, which is a mobile phone app that gives rewards for consumers to keep ordering at Starbucks. This app is extremely well made, and it is one of their best pieces of innovation in recent history, keeping customers coming back for more and more. In 2023, customers loaded over $15 billion onto the Starbucks app from 31 million different users. This money that is preloaded onto the Starbucks app is a no-interest loan that Starbucks can make do with for as long as people keep it there without yet going to buy the coffee. The payment going into this app is larger than some smaller banks get, which is just insane to contemplate. This mobile app has been crucial to Starbucks' year-over-year growth in in recent history. In addition, Starbucks also has a ton of shareholder-friendly incentives which are great for people like you and I. The first of these is their dividend, which as I mentioned previously is yielding roughly 2.5% as it stands. This is a good amount above market average, and they also have been growing this dividend for 13 years straight, which isn't too bad. Also, the dividend growth rate is pretty good, with the 5-year CAGR being around 10%. It has slowed down in recent years, but the most recent hike of 8% is still pretty solid. The other shareholder-friendly incentive is their share buyback program. It has been said that between late 2022 and the end of 2025, the company plans to give back $20 billion back to shareholders through both the dividend and the buyback program. Doing the math, this meant that Starbucks plans to buy back over $10 billion in shares between this period of time, which represents nearly 10% of the current company value. Share buybacks such as this are a great incentive for shareholders, as it means that existing shares make up a larger portion of the company as a whole, making the shares you own worth more over time, which is always great to see. The company also has decent growth with an 11% year-over-year increase in revenue and a net income increase of almost 40% year-over-year, which makes sense as this data comes from their most profitable quarter in history. The company now has a net profit margin of around 13%, which for a coffee chain is actually pretty impressive. Their decent growth and profit margin suggests that their PE ratio of 26 is justifiable, however it is still on the high end all things considered. In my opinion, I will not be buying Starbucks stock in my portfolio personally. I do believe they are a good fundamental company with solid upside potential, however there are a few issues I don't love. Firstly, they are an expensive non-necessary good that can easily be replaced. It is possible to brew coffee at home for a fraction of the price of Starbucks coffee. Obviously, most people simply don't care, however it could be an issue down the road if more people try and cut back on spending. This is why I personally prefer stocks like Coca-Cola, as you can't really make soda at home. So although Coca-Cola definitely isn't a necessity, it also isn't as easy to replace. Secondly, Starbucks does seem to be in controversy quite a bit. Although controversy doesn't necessarily mean the company will do poorly, I tend to steer away from companies like this, such as Target. I don't think the stock is bad, and considering the buybacks and dividends, I think it is a decent pickup at current prices, however it just isn't for my portfolio. Thanks for watching. If you enjoyed this video, make sure to like and subscribe, and make sure to leave your opinions down below in the comment section. I'd like to thank all of you for the support recently. We're super close now to 1,000 subscribers, which is fantastic. I'm looking forward to posting more videos more often. Anyways, thanks for watching. I will see you all in the next video. Goodbye.